Welcome back. You're still tuned into Trading Hour. It's time to talk about market fundamentals. Nilesh Shetty from Quantum Advisors is joining us to discuss the way forward for the markets and the top sectoral bets as well. Nilesh, good morning. Thank you so much for joining in, and thank you for joining on an auspicious day. So happy Diwali to you and everyone at Quantum Advisors. So looks like it's a great day for the bears. It's a happy Diwali there, but bulls seem to be taking some, there seems to be some profit booking that we've been seeing for last couple of trading sessions. Give us a sense of where do you think the market is headed? And today even IT is under a lot of pressure. What's your take here?
Happy Diwali to the entire staff at CNBC and to all your viewers. Unfortunately, I don't have that much good news. I think the correction was long overdue. I think despite the correction that we've seen this month, about 5-6%, markets, at least the small cap index and the mid cap index, is still up 25% for the year, which is a fairly strong return in equities. This is on the back of consistent strong returns over the last 3 years. So, and valuations are fairly stretched right now. And on the horizon, you see bad news coming through. Demand has taken a hit, and nobody's quite sure what is causing this dip in demand, which you're seeing especially in passenger vehicles and consumer staples. You are seeing some stress building up in the banking sector, especially the unsecured personal loan categories and microfinance categories, which the RBI was sort of aware of and was trying to push banks to sort of get their house in order. But given the risks that are building up and where the valuations are, our sense is the returns over the next 12 months will be fairly moderate, if not negative. I think investors have to brace up for a period of not that greater returns from equities.
Nilesh, totally take that point on board. Nilesh, have you had a chance to go through the commentary that's coming from Microsoft? That's been slightly muted. Capgemini too yesterday went ahead and cut its guidance. So as far as IT is concerned, are you tracking that particular space? And what are you suggesting that investors do with IT stocks currently?
Yeah, IT, despite weak numbers of the last sort of 2-3 quarters, they have done really well as a cohort. It is only sort of recently you're seeing some correction coming through. And one of the reasons was that order book or the order book that they were carrying was increasing all the time, despite that not translating into revenues. And the feedback from IT services companies, especially from India, was that clients are deferring spends, perhaps waiting for the elections to get over and trying to see when the rate cuts come through in the US. Our sense is at some point that order book starts translating into revenue. That is why despite near-term correction over the last sort of 6 to 8 months, they've had a fairly decent run. Our sense is, given where market valuations are overall, IT is not that expensive relative to the rest of the market. It is not that cheap, but it's still a place where you can have some allocation and hope for some sort of equity kind of returns over the next 12 months. But I expect, barring this correction that we've seen recently, I expect numbers from IT companies, especially IT services companies from India, to improve over the next 12 to 18 months compared to what they've delivered over the last sort of 4 quarters or 5 quarters.
Okay. Nilesh, that's on the IT space, but what about banks, the financials? Do you think that is something which stood out? Anything that you like in particular from there, the private lenders versus the public sector banks? Canara Bank reported good set of numbers this time.
So our preference clearly remains private sector banks. I mean, when the cycle turns, you sort of start separating sort of the men from the boys. And traditionally, private sector banks, well-run private sector banks, have fared really well in trying to manage the quality of the book versus public sector banks. It is in a benign cycle that public sector banks sort of move up, and then given the nature of the management and given the nature of underwriting, you start really seeing the quality of the book that they've built. So our sense is, I mean, this is the lowest gap we've seen between private sector banks and public sector banks over the last probably 10 years. I think that gap will widen. I think either public sector banks will correct and private sector banks will move higher. So at least in our portfolio, they are the largest sort of weight at the moment, given that we have valuation comfort. And I think a lot of the stock-specific problems are behind them, and they will start doing really well over the next 12 to 18 months.
Pushing further into financials, how are you looking at the NBFC space right now? On one hand, quite a few companies have called out weakness in terms of collections, etc. On the other hand, also the upcoming rate cut cycle is something that's expected to benefit them higher. In that context, how are you looking at the NBFC space?
So we've been very selective in terms of the kind of NBFCs we wanted to have in the portfolio. We did not want sort of any governance risk there. And we wanted to be very we wanted to have exposure to managements who've seen multiple cycles and they build their book accordingly. Surprisingly, despite private sector banks not doing well, some of the NBFCs have done really well over the last sort of 18 months. And we've actually trimmed our position there where we think now the risk reward is not that favorable. I think investors who are at the lower end of the quality cycle in terms of NBFCs which have exposure to subprime or risky kind of lending, they should be really careful. I think the cycle is turning and you might see a lot of pain there as sort of NPA levels build up. But if you have quality NBFCs, which have done really, really well over the last 18 to 24 months, I think that is where you may need to start booking profits as valuations reach the upper end of the valuation band that we see for this bucket.
All right, Nilesh, thank you so much for joining in today and giving us your take on the markets and the way forward as well. With that, let's move on and talk about